Okay, I will proceed to go to presentation mode. Here we go. How the First Home Super Saver Scheme works. Look, as I mentioned, it's one of the best kept secrets, and we don't like death by a PowerPoint here. So, some of these slides are just to...
It's probably Canva anyway, is it?
Well, it is a Canva template, but all the content's ours.
No, what I meant as opposed to PowerPoint.
True. That's when you know you're old, when you say PowerPoint. Anyway, we'll move on. Basically, the First Home Super Saver Scheme allows you to make voluntary contributions into super above the employer super guarantee and later withdraw those amounts plus earnings to help you buy your first home. You benefit from the lower super tax rate of 15% compared to your personal marginal tax rate. And what I want to plant is, later on in this video, Vince, I'm going to show people a little secret that could be worth knowing, but I'll just save it for there because...
Is this called teasing the hook?
I think it is. So look, ordinarily, and this is where I've got my diagram, normal home savings, and this is just to lay the land if you are new to money, new to superannuation, new to any of that stuff. You get paid your salary, you pay tax. Now that tax will be over 30% if you're earning more than 45K. And then that money goes into your bank account as your net pay for living expenses. And then you might have another goal of home savings and you've got a traditional savings account in your name. Mm-hmm. The employer contributions of 12%, they go into your super fund and the super fund automatically takes 15% tax.
Yep.
So we've agreed that's the basics of without First Home Super Saver Scheme, how we save for a house. Now, there could be a supplement here, Vince, that quote-unquote savings account could be a share portfolio.
It could be.
It could be a term deposit. It
could even be some Bitcoin.
I was about to say it could be BTC. So you might be getting a home sooner or
a TAB account.
Yeah, or later. So that's the general concepts there.
Or cookie jar.
Now, using the First Home Super Saver Scheme via salary sacrifice, you'll note here that under this salary thing, we're actually sacrificing our first home savings into super. So you can see this home deposit account is within the super circle. So we are paying 15% tax on that savings.
So instead of putting it in your bank account after your employer gives it, you're just going to tell your employer to give it straight to my super fund and I'll get it later.
Yeah, absolutely. So that's a really simple way. Now, there is another way that you can do this if you're, you could be self-employed, for example, and you want to keep a bit of a cash buffer throughout the year. And then in June at the end of the year, or you could listen to this now and be like, oh, I'm listening to this in June and I'm saving for my first house. I might put $15,000 in right now because I can't turn back time and salary sacrifice. So what you can do, you can put an amount from your savings account in the back door, we'll call it, of superannuation and claim a personal contribution on that. And then the super fund takes the 15% tax and that money that you put in will be tax deductible on your tax return.
So economically, it's broadly the same thing.
Yeah. So there's just two roads into Rome.
All roads lead to Rome, don't they?
They do. I think for the sake of this, Vince, I want to keep it maybe a bit high level. Can we just maybe assume for everything we're going to talk about now, for the First Home Super Saver Scheme, is a concessional contribution?
Yes.
Because you can use a non-concessional, but this is a broad tax strategy
and
more than anything.
The benefit of doing non-concessionals is pretty marginal.
Yeah.
It works, but you're better off focusing on concessional contributions.
So,
and obviously there's a limit on those.
Yeah, so we'll do that. So effectively, that's right there. That's the three ways things work in this world. Normal savings account, you can do salary sacrifice throughout the year, throughout each pay cycle, or at the end of the year, you can make a judgment call and say, I'm going to throw in 10, $15,000 into super. Now, it might be a good time to jump in there and say the total amount that can be used in this scheme is $50,000. However, the limit per year is
15.
Yeah.
And it's still subject to the overall limit of $30,000 in a year for concessionals. So if you're a high earner, a very high earner, and your employer contributions are already $30,000, well, you're
maybe a bit out of luck.
Here.
And because you're
unless you've got some carry forward ones.
That's right, but you're probably not using this scheme with non-concessional contributions if you're capping out your your CC caps, which is your salary sacrifice, traditional salary sacrifice.
Especially the cheese-flavoured ones.
So ordinarily, when you're ready to buy your house, and we'll get into some practical steps in what order, you have your deposit in the super fund and you put a application to withdraw effectively, and you pull that money out at your marginal tax rate, but a 30% credit is applied. Okay, so that's high level how the world works in flow, basically. You can save in your own name, invest in your own name, knock yourself out in your own name, salary sacrifice, or after-tax personal deductible contribution at the end of the financial year. No more than $15,000 a year, no more than the $30,000 annual concessional cap.
And no more than $50,000 over a lifetime.
Exactly. Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.